As we move into 2009, we have to reflect on a turbulent 2008, which took commodity prices up to some very high levels. Gold well over $1,000, oil prices 147. Performance of the big stocks was very good. We saw BHP at $50 in June, and that was against the backdrop of a US equity market which was quite weak, with a number of sell-offs starting in January and following all the way through the year, and seeing that index basically in the States falling by 50%. The third quarter and fourth quarter in Australia for resource stocks and the commodity sector was just diabolical, and it fell a lot more than 50%, and many stocks would have fallen as much as 75%, even 80 or 90% for some smaller stocks with a low level of liquidity. But since that period, since the lows that we saw in late November, we've seen the US indices steady. We've seen commodity prices bottom out, sort of, and we've certainly seen a strong gold price. Gold rising over $900 an ounce again. Now, all these things are suggesting to us that there probably is a bottom coming in the stock market. Now, the news that you see on your TV every night and the newspapers every day is certainly still very, very negative. Problems everywhere around the world, and one would think that that would be sufficient to undermine confidence in the equity markets. But performance of the equity markets over the last 2.5 months certainly suggests that maybe a lot of that has already been discounted. Risks are still there. No one really knows where it's going, but we can only follow what the markets are telling us. Now, in the first instance, come back to that point about gold over $900. That's a very important point. The silver price has also been moving up steadily, and now it's over $12 after being under 10 back in the fourth quarter of last year. We've finally seen a turn in the Baltic Freight Index, up sharply this week, reflecting a bit more confidence coming into the market for bulk commodity goods like iron ore and coal, particularly to the Asian markets. And we've also seen the gold stocks in the United States looking quite reasonable, moving up. We know that the gold stocks were sold off very, very sharply relative to the gold price. So even though the gold price might have come down from $1,000 to just under $700, with a 35% fall, the gold stocks basically fell in half, and they went to a discount to their normal index to gold price ratio. So they've been catching up to gold, and I think that they will continue to improve from there. The oil price appears to be bottoming, maybe. We've certainly got higher prices in the forward months than we have on the spot market there in oil, so the market thinks it's going to rally. The copper price is showing some signs of stabilising, despite quite substantial rises in inventory on the LME. So we have to look at all this evidence and try and work out where we're going to go to next. The other major points following on the gold price and what's happening to some of these commodities is that the US dollar had a very strong rally, as we know. Its peak coincided with the lows in the equity market. As the dollars came off, the equity markets rallied, and we generally find that when the dollar's strong, the equity market's weak. But the US dollar had another rally recently, doesn't seem to want to go further, but we'll let that market work out. If it isn't going to go any higher, it probably does mean that we'll see the rally in the equity market that has probably been expected, but there aren't too many believers there. The other key feature after the gold price and the dollar is the bond market, and the American bond market has seen yields falling now for 28 years, and what we saw late last year and into this year with a spike high in bond prices and yields of down to 2.5% on a 30-year treasury certainly look to be final spike highs ahead of much higher yields required to raise all the funds that the US government will need to fund its bailout program. So the bond market suggesting that the flight to safety is no longer going to be there. We've got another really interesting fact in the States, that there's probably $10 trillion cash in bank deposits and cash management trusts. Now, Bank Credit Analyst has a wonderful ratio of bank deposits and CMTs versus the Wilshire 5000 index, which is capitalised at about $12 trillion. So 90% of that market capitalisation is matched by cash in the banks, and that's earning less than 0.5%. So there's very low returns and possibly substantially negative real returns for cash on deposit, and that cash will probably come out when it sees the bond market weakening, when it sees the equity market probably bottoming, and it could provide a rally for us. Whatever the outlook, we really should focus on gold as doing well in whatever the outcome. The gold price in Australian dollars got over $1,400 last week. Gold price in pounds, in euros, in so many other currencies is at all-time record highs, and it's suggesting to us that the gold price really does want to go much higher in all currencies. So the gold price, I think, will do well in a deflation or inflation and maybe a hyperinflationary environment that may develop in some countries as we go through the next couple of years. So gold, I think, is a place to be. We have a series of gold stocks that we like very much. Certainly Newcrest and Lihir, people should have those in their portfolios. Dominion, Evoca, Integra, St Barbara, Sinogold, Hillend, these sorts of companies are well placed with resources, with production or near production, and they should do very well and continue the outperformance that we've had against the relative market over the last 2 months. Now, some of these gold stocks are up 100 or 150%, and they do look as if they want to go a lot higher over the remainder of the year. So the gold sector to us looks outstanding value and should be the most defensive but also the most aggressive place to be with your portfolio.